But the truth is, when you looked at the Pepsi numbers, I mean, they came out, they did well. They've been spending more on advertising and distribution networks. They've been spending, and they saw the sales, and they saw the, the good news in Life Water and Bubbly and some of the other things, right?
Yes. Well, Pepsi, the name, comes from the guy who invented it, and it was to cure dyspepsia, which is an upset stomach. So that's true. So anybody who's actually invested in this definitely does not have an upset stomach, and these stocks are great. Pepsi's it's just been tremendous. It's beautifully managed. They did very well across the board.
Right.
The stock is not cheap. It's trading at a 24 PE. Its growth rate is arguably 6 to 10%. So on a PEG ratio basis, PE versus growth rate,
right,
it's expensive. But it does have a very attractive yield, 2.9%, which is in line with the consumer discretionary and consumer staples. And you've got a yield-starved world. You've got $13 trillion in global treasuries that are trading at a negative interest rate, negative $13 trillion. So you've got people all over the world looking for yield. You just had Austria put out a 100-year bond with about a 1% yield. So these stocks are bond proxies, and they've done very well. And even the ones that are leading now this quarter, you've got the REITs leading, and the other, utilities doing very well.
Right.
So the interest rate, the ones that have nice dividend yields are great. And when you add the potential for growth, so in the case of Pepsi or some of these other guys like McDonald's, for example, they're getting a tremendous benefit from cost cutting and technology and automation. So on top of which, in this age of the internet, the inventory elements of a lot of these companies, they can manage their inventories so much better than they did 10, 15 years ago.
Well, it sounds like you like some of these consumer staple type stocks. I mean, when you talk about McDonald's and Pepsi and dividend paying stocks, I mean, they've run up. Consumer staples have run up. Is the group still attractive?
As long as interest rates stay reasonably low, and they don't have to be at ridiculous levels.
You have other groups that you also like and follow closely, that you sometimes like even more than consumer staples, right?
I've always been a big technology guy. To me, technology is the place to be. I think
And you like Amazon.
Love Amazon. Amazon combines the best of all kinds of worlds. It's consumer, and the consumer is doing so well. Everybody has a job. Incomes are moving up,
right,
and people are confident in their jobs. In fact, we just had the NFIB small business optimism numbers come out, and they were very good once again. So
right,
the consumer is spending, and the U.S. consumer spends in good times and bad, and now it's good times. So consumer stocks are benefiting from this.
Right. So chasing the dividend is still a good idea, right?
Depending on the particular company, there's always dividend traps. If the dividend is too high, then there's a reason for that. But if you have a company like Pepsi that just came out, is doing great across the board, then the dividend should keep the downside limited,
right,
but the cost cutting and the fact that they're so well managed and doing well internationally means, yeah, maybe there is more upside for this stock.
So Pepsi, McDonald's, Amazon. We've got some places to park our money.
Plenty of places to put money.
Wayne Kaufman, Chief Market Analyst at Phoenix Financial Services. Great to see you.